This is not like that dirty picture जहाँ पे entertainment. ये आपकी मेहनत का पैसा है. You have no option but learn these boring principles.
You guys have been around for almost 2 decades now.
As a mutual fund, 3 decades. As a group, 17 decades. So we were the founding members of the Bombay Stock Exchange.
There is so much money being made in the US, and in India I'm losing money just by sitting on my INR.
98 till today, even after taking care of depreciation, an Indian investor, if he has stayed invested, would have won 4% more than S&P 500. Be excited in bear markets. In bull markets, be more cautious. Bear markets give you a great opportunity to acquire shares or units much cheaper than what their intrinsic value. 100 रुपए का माल अगर आपको 60 में मिल रहा है, तो 60% रिटर्न तो आपके हाथ में ऑलरेडी आ चुका है. So human behavior of chasing what is hot, that is the biggest error we make. Investing on stories.
So how to call bullshit on a story?
Ask for these 5 questions. When Buffett retired, there was one simple tweet, 55 lakh%. And he many times says that, I started at 11 and I repent I was 11 years late. So be greedy for time horizon, not for other people who invested 5 years back and made money.
As of 2026, what are the sectors do you think will do reasonably better than the index?
So you will find universally the largest weight in our portfolios is
Hey guys, welcome back to another episode of the 1% Club Show. On today's episode, we have yet another CEO of an AMC. This time it's Mr. Kalpin Parekh from DSP Mutual Funds. So you guys have been around for almost 2 decades now. 3 decades now.
As a mutual fund, 3 decades. As a group, 17 decades.
Okay.
170 years. So we were the founding members of the Bombay Stock Exchange.
Wow. So in the last 3 decades of retail investing in India that you have observed, any interesting data points that you can talk about today, which maybe throws light on the investing behavior of Indians from the last 30 years? What has changed? Has there actually been a patient investor who has been investing for the last 30 years? Any interesting data points you can share?
Few things what have changed is when I started my career in 98, it was an era of mutual fund nahi hai.
Nahi hai.
Okay. And today's an era of mutual fund sahi hai.
Okay.
Why nahi hai? Because that was a period when markets were mostly negative. When markets would rise, they would rise for very brief periods of time and they would correct again.
This is the 90s.
90s. I started in 98. So 98, 99, then 2001, 2, 3. The first 6-7 years were, except for 1 year of market rising, generally the market used to trend negative.
Okay.
92 was the Harshad Mehta scam, I think. From that day till 2003, the markets gave 0 returns. 10 years of 0 returns. There used to be scams getting announced every few months. Capital markets were not safe. Regulations were not very investor focused. Transparency was very poor. So, bharosa nahi tha. Fixed deposit rates for 15% or 12%. Bonds, I remember ICICI and IDBI bonds would earn 14-15%. अगर बॉन्ड में आपको 15% मिल रहा है तो आप इक्विटी का रिस्क क्यों लोगे? So that was the era when nobody wanted to think of equity markets and mutual funds. Now when it comes to investor behavior, I think investor behavior is a subset of human behavior. Human behavior does not change. कुछ भी कर लो, human behavior is human behavior. It is a function of our evolutionary wiring. हमारा DNA जो भी लाखों साल पहले या 50,000 साल पहले बना है, वो more or less continue होता है. And evolution is very slow process. So 30 साल में nothing much changes from a behavior point of view. Even today, the average or the below average investor who is a human being is still excited by what did very well in last 1 year and is still scared by what is down 50%. जो नेगेटिव रिटर्न देता है आप डर के हम भाग जाते हैं जबकि वो उसका टाइम शुरू हो रहा है.
Have you ever wondered how much money you need to retire based on your monthly expenses and your investment growth rate? Do you know what is your retirement age? This question bothered me for the last 10 years. So I thought, why don't I just build an app around this? So at the 1% Club, we are now launching our FinTech app powered by AI. This is the first time AI is being fed on your own personal financial information and giving you advice like a professional money manager. Head over to the 1% Club app right now, install it, track your FIRE number and invest money like a professional money manager. It's completely free of cost, so try it right now.
When markets fall, when prices fall and NAVs fall, the risk is falling. But people think ये तो risky है. When NAVs are booming, the risk is rising. But people think, no, this is safe. So human behavior of chasing what is hot, chasing what has done very well in the last 3 years, what is in headlines right now, what is commonly being debated or discussed, people think यही story है. And so that has not changed. Behavioral mistakes have not changed. So chasing past returns, investing on stories and narratives, not investing by reading properly, by being more disciplined, by looking at objective data points, those things have not changed. Holding periods have not changed. In fact, holding periods have only gotten lesser and lesser because ease of transaction has gone up. So जितना स्पीड से हम पैसा इन्वेस्ट करते हैं 2 बटन दबा के ऑलमोस्ट 1 बटन दबा के हम निकाल भी सकते हैं. So those things have not changed. And lastly, I give this example, very boring repetition. The oldest fund we have is roughly 30 years old. It has compounded by around 19% CAGR. It has done 3-4% better than its relative benchmark. So there's no reason anyone should complain about that fund. It's called DSP Flexi Cap Fund. 19% CAGR in 30 years is roughly 122 times growth. Over this 30 years, 60 lakh investors have invested in DSP and gone away. In this fund, 23 investors have lasted for these 30 years.
That's it.
Yeah. So we have made money. But who has earned money? किसके लिए बनाया हमने? We don't know. 23 लोगों के लिए बनाया. And that is the reality of investing everywhere in the world. This does not change. Because the biggest variable of making wealth is time. और वो ही हमारे पास नहीं है. हम वो ही नहीं देते हैं. We give enough attention to every other noise around the world. We jump every 3 years. Many times, I'm not demeaning anybody. I have been an investor like this in the first 10 years of my career.
Yeah.
I was one of the worst investor I could ever have been. Like a dog chasing every car. अब एक गाड़ी आया उसके पीछे भाग गया. ये चला गया. You can't catch it. Then another one came, but you are never getting in the train.
Yeah.
You keep, chasing and barking, but you never participate. The game is about being in the vehicle. Choose your 3-4 vehicles right. It could be a flexi-cap fund. It could be a multi-asset fund. It could be just an index fund. It could be 3 active fund managers. It doesn't matter which one have you chosen. What matters is, are you a 5-star investor? We choose 5-star asset classes, 5-star fund managers, but we don't do anything that is needed to be a 5-star investor ourselves, which is give time and not get carried away every year by hunting for what has done very well in the last 1 year.
No, you're right that human behavior doesn't change that easily. But the people who are good investors, would you say that they're a little bit more evolved in terms of understanding their behaviors and resisting themselves from making those mistakes?
Of course. See, there is evolution, right? However slow it is, a set of investors will evolve. तो है ऐसे, but maybe वो 10% होंगे या 5% होंगे. I had done this data analysis, I think 8-9 years back. I need to refresh that. So we had broken down markets into 3 color zones, green, yellow, and red. And let me give one concept before that. If you invest in equities in a bear market, you make super normal returns. Less than 1% investors do that.
That's it.
Yeah, because in a bear market, everything around us is negative. Most likely you will not even call me. Because equity itna kharab chal raha hai, why would you want a mutual fund CEO to come? Or in a bear market, headlines are so bad. Every headline is screaming that run away from equity. 1 year return would be down 40-50%. It would be like a COVID period. The courage to invest is not there. Typically in a bear market, job losses might be there, or fear of a job loss might be there. I have survived or seen 3-4 such bear markets. 2000 का bear market देखा है, 2008 का देखा है, 2017 से 20 COVID bear market. But let me give a data point to validate this point. And this is most important point. Investors celebrate bull markets. Media, collective media, and the industry also feels more happy in a bull market because our current returns look very good. But if we are going to be investors for the next decade or two, bear markets give you a great opportunity to acquire shares or units much cheaper than what their intrinsic value. 100 रुपये का माल अगर आपको 60 में मिल रहा है, तो 60% रिटर्न तो आपके हाथ में ऑलरेडी आ चुका है, बिकॉज वो माल 100 का है, आप 60 में खरीद रहे हो. So you're buying at a discount, you're already in the money on day one. Just that you'll realize it with some time. In the year 2008, January, when markets were at all-time high, I think Sensex was at 23,000 that time. Ps were very high. The story was about India will rule the world. India, China, BRICS became the buzzword. And this was on the back of last 4 years of super normal returns. So lots and lots of money came in into infrastructure funds at that time. Since that day till today, and all headlines, if you open up any newspaper, and I'm asking investors to just go and Google, that 1st January 2008 से लेके 6 January 2008, वो 6 दिन की headlines क्या थी? You would feel so proud that, हम तो दुनिया को जीतने वाले हैं. उस दिन से आज तक का इंफ्रास्ट्रक्चर फंड का रिटर्न या इंडेक्स का रिटर्न सिंगल डिजिट है, सेविंग्स अकाउंट जितना रिटर्न है. And a government bond would have earned 9% return in that period. And this is a serious 18-year of history. If you had waited for 9 months and then a crisis happened, the global financial crisis happened, stocks crashed 50-60% everywhere in the world, including India. So Nifty from that peak till today has earned 10% return. Most money went into infra that time. Like right now, most money is going into AI given a choice. That time it went to a narrow theme called infrastructure. Infrastructure funds would have given 5% return from that day till today. Less than savings account. Nifty, which is a broad-based index, उसका भी आधा exposure infra में था तभी. Today जैसे आधा exposure banks और technology में, that time it was in infra. Nifty gave 10, the hot category gave 5. 9 months later, when markets crashed, and if you had invested, instead of 10, you would have earned 17% CAGR over 18 years. So 7% CAGR gap is huge. What is the learning here? Be excited in bear markets. In bull markets, be more cautious. Be more calibrated. Don't put all your money. Once in 12 months, we publish a principles document, a principles edition or a foundation element, a foundation edition. It's on first principles of investing, that what is good investing all about. It says that, how should you think about SIPs? When do SIPs make money? When do SIPs not make money? So every 12th edition is a learning edition like this. It doesn't opine about the here and now or a view, but it talks about the bedrock of investing, the principles of investing. So these are the concepts which are a part of these documents. Like SIP also, a lot of people think, डाल दिया तो पैसा बन जाएगा. But it is path dependent. So let's say if markets are at 100 and 5 years later also are at 100, you made zero return. Yeah. But if in the journey markets fell 50% first and then came back to 100, came down and went up, you will make 6-7% return because you averaged all the way down. On the other hand, start and end point is the same, but first markets went up from 100 to 150 and came down to 100. You will average up and then lose money. You will make negative returns. So for the same start or end point, the path will determine what return you will make. Path dependency is a concept which most people don't know, and it is rarely ever explained. So that these are the type of things that we explain in these documents. Ki path will determine. And finally, what we say is that almost always the future is unknowable. Let's be humble about this game. This craft of investing or this field of investing is about reasonable uncertainties in the near to medium term. In the long term, few things are certain. If you buy good companies at good valuations and give long time period, you will generally make inflation plus 5-6% return. Now, these are the principles that a young investor needs to learn if he wants to start becoming a serious long-term investor, because this is serious business. This is not an entertainment business. This is not like the dirty picture जहाँ पे entertainment. लोगों को entertainment अच्छा लगता है, interesting conversations अच्छे लगता है, stories बहुत अच्छी लगती है सुनने. But जब कोई boring data होता है तो people switch off. But ये आपकी मेहनत का पैसा है. You have no option but to learn these boring principles. Now let me also highlight that some of these are not easy to understand, and these are like concepts of medicine that I'm explaining to somebody who's not a doctor. Yeah. And hence you need to have a doctor as your advisor. So either you find a good advisor who will guide you right, or you learn these principles, or you follow what Ben Graham has taught to students of investing. He said
that book is also very tough.
It's also tough and a dry book.
Yeah.
But there are a couple of chapters. Chapter 8 and 20, everybody should read. They are reasonably easy to understand. But he has said something very powerful. He says that people like you and me, let's assume we are not from the industry, we are not expected to know all these concepts, right?
Yeah.
And hence, you should build a portfolio which allows you to say, I don't know and I don't care. So if I were to say that, next 5 years, India will not do well, but US will do well. But if you are able to say, I don't know and I don't care, or if I tell you, no, but Sharan, in the next 5 years, not AI, but global healthcare will do well. And if you want to answer, I don't know and I don't care. If I tell you that, Sharan, forget the global, I think India will do well. You should be able to say, I don't know, I don't care. Sharan, bonds will do well. You should be able to say, I don't know, I don't care. When will you be able to do that? When your portfolio is diversified. It will have something always which is doing very well. A diversified multi-asset portfolio will generally deliver that type of outcome. It may not give you the highest return, but it will ensure you never have the highest fall. So you're not thrown out of the game. You need to be in a train which takes you to your destination, but which does not shake so much that you get thrown out. And that is what good investing is all about.
So, have you heard of this person named Mr. Leopold Aschenbrenner?
No.
So, this is a 25-year-old investor who has just gone viral on social media. So, here's the thing. So, he has, been fired from OpenAI.
Okay.
And then he launched this fund called Situational Awareness.
Okay.
He started with $225 million, which is about 2,000 crores. And in less than 2 years, he is now sitting at almost $15 billion, right? And his thesis is, AI, the energy transition sector of AI. So now, for somebody sitting in India, when I'm seeing a reel like this or a post like this, that there is so much money being made in the US, and in India, I'm losing money just by sitting on my INR, which is losing value because of war and Trump and all of that. What would be your advice? Because these are facts which are happening in the world today.
True. I think, in fact, I did read about this, but I didn't recollect the name. And yes, it is a fact that in the last 3-4 years, everything related to AI has done reasonably well. But investors don't need to worry. If they had thoughtfully, followed the right role models or listened to the right inputs, there were enough funds in India which were investing in similar global strategies or themes. For example, in the year 2000, 6 years back, we launched a value fund where 35% is invested globally. And in fact, 3 years back, we had stocks like SK Hynix in the portfolio, which has today shot up almost some 1,000% in the last 1 year. We have invested in stocks like ASML, TSMC, NVIDIA, all through this cycle. We launched a fund called Global Innovation Fund, and we doesn't mean only DSP. Many of our other peers launched a Global Innovation Fund in 2021, 5 years back, before even this AI craze started. So the fund industry offers this entire range of products. Unfortunately and ironically, most attention goes to just plain in a large cap, mid cap, small cap, or so on and so forth. And again, here, the whole social media industry spoke about small cap funds 3 years back. But that was also the time when all these funds were available. But that time, small caps in India were doing very well. So what tends to happen, Sharan, is, human beings fall in love with what is happening right now. The way everybody is falling head over heels to, global stocks today or AI stocks today. 3 years back, everybody was falling head over heels on the India story, on the manufacturing resurgence, on the China plus one story, on the defense story in India. And a lot of these companies in India also have made money. Defense stocks have made money. No doubt the currency has lost in the last 1 year, but long term, our currency tends to depreciate by 3.5%. But let me tell you, I have been investing in mutual funds since 98, accidentally, because I started my career in a mutual fund. So I've been very blessed that I got to understand the right nuances. But 98 till today, even after taking care of depreciation, an Indian investor, if he has stayed invested, would have won 4% more than S&P 500 in rupee terms. So typically the Indian market, if you stay invested over a full cycle and, take advantages of intermittent periods of correction or zero returns or negative returns, you will earn reasonably similar or competitive returns like the rest of the world. On the other hand, there are enough periods when global stocks go through corrections. Like China is going through a correction right now. Consumer stocks in US are down 40 to 60%. The largest pharma stock, Novo Nordisk, is down 75% in dollar terms. If you are building a portfolio of such companies, in the next 3 to 5 years, you might make reasonably good returns there. Every year, the story which is very hot, when you pick that story, you will burn your fingers, but you will not get to know that moment. At that moment, you'll feel very excited. Unlike a real world where you burn your fingers immediately, here, you'll realize it 2-3 years later. Now, I don't have a view whether the AI story will burst in 1 year or 3 years or whether it will not burst at all. But broadly, there are signs and signals of froth. So Sharan, what I'm saying is that yes, it is a fact that we've not done that well in the last 1 year in one segment of mutual funds. But there are 5 other segments of mutual funds. If you have not searched for them the right way, it is not that the category has not delivered. Multi-asset funds have done 22% CAGR in the last 3-4 years because they participated in gold, in silver, in global stocks, and in global stocks across the world, not just one particular slice. Any day, any time, 10 years back, today or 10 years later, there is something which will be very hot in the market. Some portfolios will have some component of it. A thematic portfolio may have a slightly higher component of it. But these are cycles, and we should not get worried about, or we should not form investment opinions based on what's happening today. And the currency depreciation is nothing new to India. Yes, what is new is such a sharp depreciation in the last 1.5 years because 2-3 things happened together. There was a bit of intense FII selling, FPI selling. So they were selling and taking, dollars out. Coincided with the trade wars around the same time. And the trade wars also, created fear that India growth will slow down. Coincided with higher valuations of the stock market. We have flagged off in February 2024, 6 months before the market peaked, that these valuations are unreasonably high. You may want to de-risk by diversifying away from only Indian stock portfolios. And the fourth thing that happened was the Iran-Israel war, which led to rising oil prices. So all of this happened together. So a normal 4% depreciation, actually the long-term depreciation of our rupee is 3%.
Yes.
But all of this came together to see a very sharp 12% depreciation. But of course, since the announcement of FCNR bonds, since the announcement of slowing down of the war situation, the rupee has appreciated by 3-4%.
Yeah.
So these cycles will be there. The way I think about investing is that over a long period of time, we may depreciate by 2-3% as a currency. There will be some bouts in between like this. You need to build a portfolio which is resilient to currency depreciation, but which is also beneficiary of certain growth story which is available in India.
As of 2026, what are the sectors do you think will do reasonably better than the index compared to the probabilistic signals you're looking at?
So the best way to see is what is my, most of my funds, which are broad-based funds, or which is a sector rotation fund, the business cycle. Iska largest weight kya hai? So you will find universally the largest weight in our portfolios is banking and financial services right now.
You think that's going to go through an upcycle now?
We've been thinking this for the last 1 year and we've been wrong. Let me also give that honest disclaimer. But we believe that 5 saal ka almost mediocre return. The stocks of banks have earned less than the FDs of the bank.
Wow.
Right. Ideally, the stocks should earn 15-16% ROE.
Yeah.
But FD ka return bana, because 5 years back, that was the hot sector. And it went through a slowdown. The health of the sector is impeccable right now. It is at its best ever in our industry. NPAs are very low, spreads are high, credit cycle शुरू नहीं हुआ है, और valuations 10 साल 12 साल पुराने valuation पे है. तो ये thesis के base पे we feel BFSI is a good sector to be in.
But most mutual funds are usually very heavy on this sector.
They are because of, so 2 reasons why they are heavy. One, because it is also the largest sector in the index. Number 2, if you take the total profits of corporate India, 35% of profits are generated also by the same sector. So वो ऐसे ही ज़्यादा weight नहीं है उसका, weight ज़्यादा है for a legitimate reason. Of that, it has gone through a phase of significant underperformance, and especially some of the finest banks, whether HDFC Bank, Kotak Bank, Axis Bank, they've had their own rounds of certain missteps or certain changes or certain anxieties, which is why also they've corrected. Some of the correction is legitimate, and some of the correction is also because FPIs have sold a lot, and they used to own a large weight in banks. FIIs, if they had to sell, वो बेचेगा जो है उसके पास सबसे ज़्यादा. So all these things have made the sector. So there is a pendulum ka center. Then in bull markets, one sector goes to right extreme when it makes very high return, which is Tiger right now, healthcare right now, natural resources right now. Then there are some sectors which are on the left side. So banking is slightly on the left side. Technology is more on the left side because यहाँ पे doubts ज़्यादा है. Banking पे doubts नहीं है. Visibility of earnings नहीं है. NPA crisis की visibility नहीं है. So and that is why the weights are high. In technology, few brave investors have started increasing their weights, but many are waiting, saying, let us get more clarity of growth from these companies themselves. Like one part of my team in DSP itself says that I want to keep zero weight here because jab tak they don't increase their headcount, we know that demand shuru nahi hone wala hai. So we'll wait. But there is a small group in DSP which also says that if I wait for perfect data, तो शायद भाव 25% भाग जाएगा. So let me start nibbling in right now. So if I want to keep a 7-8% weight, let me start by 1-2-3% and gradually build that. So these are approaches because there is never certainty. Clarity doesn't give you great entry prices. Buffett का वो statement है that if you pay for a cheery consensus, prices will be very high. You'll rarely make money. You need to invest in uncertainty. Prices are cheap only when there is uncertainty. Then you have to ask just 2-3 questions. Are these companies managed well? Is the industry a good industry? Does it generate free cash flow? These companies generate free cash flow. They don't need to do capex. They don't have to, spoil their balance sheet. So most likely these are two sectors where, we should be fine. From a short cycle point of view, we see cement, power, automobiles. They are at their earnings low. Because of the economic cycle right now. So वहाँ पे normally economy has shallow cycles of growth and slowdown. So we believe auto should do well. That is a large weight. We believe cement should do well. Because
do you think power should do well?
And these are three I mentioned: cement, power, and
okay, you're saying it's in a down cycle now. It's gonna go.
Could do well. See, these are again probabilities. I will never say anything with certainty. But these are the sectors which are large, relative large weights. But starting from banking, then we have auto, then we have cement. Or tech, a lot of people in my team are still not positive. I can only say in disclaimer and honesty that many times when everyone is negative, I have this instinct in me, थोड़ा उल्टा करना है. सब लोग नेगेटिव है तो थोड़ा कर लेते. तो मैंने अभी कुछ दिन पहले DSP का जो टेक इंडेक्स फंड है उसमें कुछ पैसा लगाया. आई हैव जनरली नेवर डन अ सेक्टोरल इंडेक्स फंड बिकॉज वी हैव sectoral active funds, healthcare, natural resources, banking.
Yeah.
But I did this because most of our funds are still underweight. So if I, on my personal level, have to go overweight, I have to then buy the theme. Whether my decision is right or wrong, time will tell. When you call me next time, you can ask me.
So hearing whatever you're saying, India is a, fast growing country. Yeah. There is a lot of demographic dividend that we are sitting on. So almost all sectors are going to do well. Is there any sector which is not going to do well?
See, let me also now break another myth. That fast growth does not mean stock market returns. We spoke about it, right? China grew the fastest. So China's GDP has grown very fast. Then GDP grow hota hai to revenue growth hota hai companies ka.
Yes.
But China did not do efficient capital allocation. They kept on building. GDP को growth मिल गया. But companies का जो return on capital है वो dilute हो गया because they spent more than what was needed. They made longer railway tracks than what was needed. They made more steel plants than were needed because they were obsessed about growth. They made ghost towns. There are stories about it that there are towns and towns जहाँ पे कोई रहता नहीं है. तो capital लगा दिया. अब capital लगा दिया उसे income नहीं आया तो return on capital कम हो गया. So if you see India and US have a 16% return on capital. China is roughly at 12 or 13. And that too because of some of their tech companies like Tencent or Alibaba or those companies. If you go to their core sector, the return on capital will be single digit. And the third thing is they needed more and more capital to achieve the same level of growth like India. Capital ज़्यादा लगा दिया. India ने कम capital पे वो growth achieve किया है. China ने ज़्यादा capital पे किया achieve. Also, there were more dilutions.
Can you explain that? How is India more capital efficient than China?
Return on capital is a signal of capital efficiency.
No, but how are we? Is there something in our DNA which makes it better?
So see, there are good and bad effects. If you are high, if you are more obsessed about capital efficiency, you will spend less. Frugality basically. But when you're frugal, you also don't invest in future innovation. So आज की तारीख में लोग क्या बोल रहे हैं? चाइना के पास इनोवेशन है, इंडिया के पास नहीं है. बट इसलिए इंडिया का ROE भी ज़्यादा है ना. अब ROE ज़्यादा है इसलिए पिछले 15 साल में इंडिया ने रिटर्न ज़्यादा दिया है चाइना से. बट शायद अगले 10 साल में इंडिया और चाइना का ग्रोथ सेम हो सकता है बिकॉज चाइना ने कैपिटल लगा दिया है, इंडिया को लगाना पड़ेगा. देयर आर मोर एंड मोर न्यूआंसेस लाइक दिस. Number one. So number two, so growth does not necessarily equal to stock market return. Number two, if the growth is priced in, again you can't make returns. You'll make moderate returns. Returns banega, but superlative nahi banega. So where are we right now in India? See, mandi mein our P's go to 12-13 times.
Sorry?
The price to earning ratio of our stock market goes to 13 times in very extreme.
Okay, you're assuming if it becomes, okay.
Hua hai, 2000 low, 2001, 2, 3 low, it went to 12-13 times. 2008 low, it went to 12 times. 2017, 2020 COVID low, it went to 16 times. But on the high side, जब euphoria होता है, it goes to 25, 30 times. So these are the extreme points. So the more closer you are to 15, 16, your odds of better returns increase. The closer you are to 25, your future returns will be moderate. We are in the middle right now. We are neither cheap, we are not expensive. So हमारा जो भी growth होगा, now we have published a slide in Nitra again for last 50 years of our growth, annual GDP growth. We have grown on an average, let's say at 7.5%.
Okay.
Only for very short periods we have grown at 10%. Currently we are growing at 6 to 7% range. And I think that is not a bad number because that is still the second fastest growth in the world. उससे ज़्यादा growth करने के levers फिलहाल नहीं है. But even if you grow at 6-7%, add 4-5% of inflation, 11-12% is profit growth rate or revenue growth. If you are able to buy these businesses at 17-18 PE, 10-12% return बन सकता है. Versus that inflation is 5%. So you are earning a reasonable premium over inflation. So it's nothing to worry about. But there is no setup where I can say बहुत पैसा बनेगा, 20% बनेगा. So the problem with a lot of investors who have come in the last 5 years is 20% expectation, 15% expectation.
I think 15 has become bare minimum expectation.
वो odds of that are very low, reasonably low, I will say. For that, you need a bear market.
So we've talked a lot about what is your thesis today and how you're probably investing today. Can you tell me some of the biggest mistakes that you've done?
2003 to 7, Nifty went up 7 times. The small cap index went up 15 times. Since that day till today, a couple of small cap indices are up only 3-4%. I mean, that period, I bought a lot of stocks. I've stopped doing stock investing directly because now I do everything through mutual funds. But in that period, I used to do a lot of stocks. And I would buy stocks without knowing it कौन से धंधे में. I would buy stocks because they were going up. मेरा बहुत ही सिंपल रूल था खरीदने का. ये ऊपर जा रहा है तो खरीद लो और किसी ने बोल दिया तो खरीद लो. There were 2 stocks which were in the infrastructure space. I even give ABG Heavy and ABG Industries or something. Someone told me, you stay in Borivali. If you buy them, you will move to Colaba very fast. And the stocks were doing very well. First month 20% ऊपर, second month 20% ऊपर. So I put small money, went up another 20%. So that gives you confidence. So when recent fast returns make you feel overconfident, you put more money.
Yeah, that's the
But I had no idea.
very dangerous.
Dangerous. Now, what I had to learn, which I never did in that era, was what is this company all about? इसका रिटर्न ऑन कैपिटल बनता है कि नहीं बनता है, इसका बैलेंस शीट साफ है या नहीं है, इसका गवर्नेंस कैसा है.
Who cares? You're just making money.
I'm making money. Or that you should care about these things also was not known.
Yeah.
When you are naive and young, you don't even know what are the rules of investing. Investing करने के लिए पहले चेकलिस्ट में 3 चीज़ चेक क्या करनी होती है, ये पता ही नहीं था. 99% of us start investing that way. If you ask people, okay, you have 20 stocks in your portfolio, give me one line reason why do you have them. Trust me, that is the most important exercise people need to do. It should not be, it is the largest infra company and hence I have it. But is it capital efficient? Is the balance sheet clean? Is the governance track record good? Is it at peak of cycle? Is it valued right? That is an important question to answer. If we cannot answer those questions, we should not touch stocks. Now, there is a museum of such companies I have, which would be down 95%.
Okay.
Since that time. Basically, they've never come back. There will be many like that. 2000 के साल में there was one company, SSI something, Software Solutions. The story was, और ये सब मैंने तब story पे पैसा लगा. And the stories always sound logical. The stories are very convincing. And that is the biggest error we make, investing on stories.
So how to call bullshit on a story?
Ask for these 5 questions. Have a checklist. ROE क्या है? Valuation क्या है? Balance sheet कैसा है? Cash flow बनेगा कि नहीं बनेगा? Promoter clean है कि नहीं है? ये जानना ज़रूरी है. उसके बिना you can't invest. If you don't know these things, what is the need to do direct stock investing?
So, how frequently do you make changes to your portfolio?
Reasonably infrequently.
So in a year, how many times do you touch it?
Ideally I will never make, because I am a passive investor in an active fund. When should I act? Ideally, let's say, like I gave this example of gold mining. I invested aggressively all through 2020, 21, 22. For 5-6 years, I did nothing. But then when it went to an extreme point, is when it became a large part of my portfolio, is when I need to revisit my decision. evaluate my decision, and if data merits I should act. Sometimes you just reflect and do nothing. Reflection can be frequent.
So how do you do this reflection, and how frequently do you do this reflection?
So Sharan, I'm maybe the wrong example, but because my job is to do this for my salary, तो अपने आप ये हो जाता है. But generally, I'm saying for the average, for the common investor, you do this once in a year, or when once in 6 months you see your portfolio. Let's say your portfolio mix is, 65 Indian stocks and 35 is in gold, and let's say that ratio got tilted to 50-50. It's a big shift.
Yeah.
Whatever ratio you had decided for yourself, if it moves 5% absolute points or 10% absolute points, is a big shift. Then you ask this question that, okay, why has this shift happened? So let's say 65 equity hai, 35 gold hai, and 65 has become 80 because stocks have run up very sharply or gold has crashed sharply. That is why that 35 would have become 80-20.
Yeah.
Then you evaluate that, okay, now is 80-20 right? Or now because gold has crashed so sharply, there is merit in having more gold again. Which means if now I have new money to invest, let me put everything in gold. Or if I don't have new money to invest, do I want to rebalance and trim little bit of equity back into gold? So at the margin, at extreme points, should you act?
I think on that note, Kalpin sir, I think let us call an end to the podcast. I think it's been a very long conversation.
Thank you so much
Thank you so much for
patience.
patiently, explaining every single thing. Is there any last piece of advice that you like to share to the audience before we end?
I think two things. In the long term, staying invested makes money. In the short term, being greedy loses money. So if you can solve for both as an investor, you will earn reasonably good returns. Stay invested for long term. Don't keep jumping every 2-3 years, and don't keep chasing fast moving cars or fast moving trains. If you want to enter a train, let it stop at the station. So avoid chasing hot stocks or hot themes or hot funds, whether in India or the world. If you want to reduce volatility, you need to diversify. So diversify. When Buffett retired, there was one simple tweet. It's one of the most powerful tweets on compounding. It just had one number, 55 lakh %. This is the return he has made since he started investing. And he has been investing for...
From the age of 15, right?
11.
11, okay.
So he's been investing for 85 years. So his entire cycle is... So the tweet was only just 55 lakh %. No story, no gyan. And he many times says that, I started at 11 and I repent I was 11 years late.
Sorry, he started 11 and?
He says, I started investing at 11 and I was 11 years late.
Oh.
Because in 11 years, if he had got that 11 more years, he would have done 3 more compounding. So this 55 lakh %, if you compound at the same rate, would have been 3x more. Because every 4 years, he doubles money at the rate at which he has compounded. Or every 5 years, he would have doubled. So that is the greed he has for time horizon. So be greedy for time horizon, not for other people who invested 5 years back and made money. So ignore past returns. Focus on discipline and how long can you remain invested. My most favorite quote from Morgan Housel is, and this is what I try to follow, I want to earn reasonable returns for unreasonable amount of time. I don't want to chase unreasonable returns in reasonable periods of time. Tough to follow?
Yes, very tough.
But और कोई तरीका नहीं है. Or be lucky. So,
alright, I think that's a great note to end the conversation. Thank you so much, sir. And guys, if you had any feedback on this conversation, please feel free to drop them down below. And before I let you go, sir, I wanted to ask you any future guest recommendation that you have that you feel is right to come on this podcast next.
There's so many. One of my colleague or friend, ex-colleague and friend, Ashish Somaya, he's also been
he's come
in the
here.
industry. He's already come?
Yes.
Fine.
Very good speaker.
Yeah, then, one of our veteran in our industry is Nilesh Shah.
Yes.
He can explain investing most complex topics in the simplest of a manner. Every time he does an interview, I envy him.
Watch it.
I envy
Okay.
that how can he do it and how can I not do it. So there are some of these guys who are very objective, who are very intelligent, who are very, persuasive in how they explain these concepts. There are many more. I don't think I've done justice. So I can give you a long list later on.
No, I think this list is good to start off. Thank you so much.
Thank you.
All right, guys. On that note, I'll see you in the next one. Before you go, guys, if this video gave you even one insight and made you feel differently about money, don't just keep it to yourself. Share it with your friends or family member who could use it too. And if it has sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make this conversation sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with one new thing every Wednesday and Saturday.